What if you could turn $100,000 into millions by making just a few strategic moves? It sounds like a dream, but with the right dividend ETFs, it's entirely possible. In a world where most investors flock to the usual suspects, there are lesser-known ETFs quietly building wealth at an astonishing rate. In today's video, we are uncovering 3 powerhouse funds that have the potential to transform your financial future. I'm going to show you how these ETFs stack up, break down their unique strategies, and reveal exactly how much you could earn with a $100,000 investment. We are living in an age where the path to wealth creation is more accessible than ever before. Yet so many people still struggle to make their money work for them. That's where ETFs, or exchange-traded funds, come into play. These powerful investment vehicles offer a unique blend of diversification, low costs, and potential for high returns. However, not all ETFs are created equal. Well, there is a misconception that you can only get returns through well-known ETFs, but that's completely based on lies. There are a few ETFs that are hidden from the world and can provide you with returns that you have dreamt of. One of those ETFs that can turn $100,000 into millions is Schwab US Dividend Equity ETF, known by its ticker symbol SCHD. Since its inception in 2011, SCHD has emerged as a beacon for investors seeking a perfect blend of income and growth. This ETF is engineered to mirror the performance of the Dow Jones US Dividend 100 Index, honing in on high-quality U.S. companies that boast a robust history of dividend payments. Now, you might be wondering why we're starting with a dividend-focused ETF when we're aiming for explosive growth. But SCHD is far from your run-of-the-mill dividend fund. As of June 2024, it commands an impressive $58.63 billion in assets under management, making it not just one of the largest dividend-focused ETFs in the market, but also one of the most dependable. What truly sets SCHD apart is its winning combination of cost-effectiveness and stellar performance. With an extraordinarily low expense ratio of just 0.06%, SCHD ensures that more of your hard-earned money goes towards generating returns, rather than being eaten up by fees. To put this into perspective, for every $10,000 you invest, you're only paying $6 in annual fees, less than the price of a premium coffee. Let's get into the heart of SCHD, its holdings. As of June 2024, SCHD's portfolio comprises 103 stocks, with the top 10 positions accounting for a substantial 41.15% of the fund's total assets. We're not talking about ordinary companies here. These are industry titans like Texas Instruments, Amgen, Lockheed Martin, and Coca-Cola. Companies that have consistently grown their dividends year after year. Let me give you the real-time performance number that really matters. SCHD currently offers a dividend yield of 3.39%, underpinned by an impressive 10-year average dividend growth rate of 6.39%. But here's where it gets even more interesting. On top of these dividends, SCHD has achieved an average annual share price appreciation of 10.84% over the last decade. So what does this mean for your $100,000 investment? Let's break it down. After just 1 year, your investment could potentially grow to approximately $114,290, taking into account both share price appreciation and dividends. Fast forward to 10 years, and that $100,000 could potentially triple to $292,450, assuming you reinvest your dividends. But the real magic happens over the long haul. After 30 years, hold on to your hats because your investments has the potential to balloon to a staggering $5.64 million, with reinvested dividends playing a crucial role in supercharging your overall returns. And by year 30, you could be receiving annual dividends of over $190,000. That's nearly double your initial investment coming back to you every single year in dividends alone. If SCHD is the steady Eddie of our trio, Invesco QQQ Trust, QQQ, is the high-octane growth engine that could potentially turbocharge your returns. QQQ tracks the NASDAQ 100 index, which means it gives you exposure to 100 of the largest non-financial companies listed on the NASDAQ. We're talking about tech giants like Apple, Microsoft, Amazon, and Google, as well as innovative companies in other sectors like Tesla and Starbucks. Essentially, QQQ is your ticket to riding the wave of technological innovation and disruption that's reshaping our world. Let's break down what makes QQQ so special. First off, its performance has been nothing short of spectacular. Over the past decade, QQQ has delivered an average annual return of about 20%. To put that in perspective, if you had invested $100,000 in QQQ 10 years ago, you'd be sitting on over $600,000 today. That's the kind of growth that can turn everyday investors into millionaires. But it's not just about past performance. QQQ is positioned to capitalize on some of the most exciting trends shaping our future. Artificial intelligence, cloud computing, e-commerce, electric vehicles, the companies in QQQ are at the forefront of these revolutionary technologies. By investing in QQQ, you're essentially betting on innovation itself. When it comes to costs, QQQ's expense ratio of 0.20% is slightly higher than our first ETF, SCHD. However, this fee is still competitive, especially when compared to actively managed funds, and it's justified by the fund's stellar performance. Speaking of performance, QQQ has been nothing short of impressive, delivering an average annual return of 18.65% over the past decade. This significantly outpaces the S&P 500's approximately 12% annual return over the same period, demonstrating QQQ's ability to not just keep up with the market, but to substantially outperform it. To put this performance into perspective, let's consider how a $100,000 investment in QQQ might grow over time. After just 1 year, based on a conservative 1-year return of 3.47%, your investment could grow to $103,470. Fast forward to 10 years, and assuming the historical average annual return of 18.65% with dividends reinvested, your initial $100,000 could potentially balloon to around $547,140. Even more impressive, if this growth rate were to continue for 30 years, your investment could reach a staggering $8.85 million. Of course, these projections assume you're reinvesting any distributions from the fund. QQQ's dividend yield is relatively low at around 0.5%, but reinvesting even these small payouts can significantly boost your long-term returns thanks to the power of compound growth. Now, I know what some of you are thinking. Isn't QQQ too risky? What about diversification? It's true that QQQ is more concentrated than the broad market ETFs. Its top 10 holdings make up about 50% of the fund's assets. And yes, it can be more volatile than the overall market. During the dot-com crash, for example, QQQ took a bigger hit than the S&P 500. But here's the thing. With potentially higher returns comes higher risk. If you're young and have a long investment horizon, or if you're simply willing to stomach some volatility in pursuit of potentially life-changing returns, QQQ could be a game changer for your portfolio. And remember, we're not suggesting you put all your eggs in one basket. QQQ can be a powerful component of a diversified investment strategy. Speaking of diversification, let's move on to our third and final Millionaire Maker ETF. If SCHD is our steady income play and QQQ is our high-growth rock star, our next ETF strikes a balance between the two. I'm talking about the Vanguard Information Technology ETF, ticker symbol VGT. VGT gives you broad exposure to the U.S. information technology sector, including software, hardware, and IT services companies. While there is some overlap with QQQ, VGT is more focused on pure-play tech companies and includes smaller firms that don't make it into the NASDAQ 100. As of August 2024, VGT boasts an impressive $87.2 billion in assets under management, cementing its position as a major player in the tech-focused ETF space. Its concentrated exposure to some of the world's most influential tech companies makes it unique among all of them. Over the past decade, VGT has delivered an impressive average annual return of about 21%, slightly edging out even QQQ. But because it's more diversified within the tech sector, it holds over 300 stocks compared to QQQ's 100, so it can offer a smoother ride. Let's crunch the numbers on what VGT could potentially do for your $100,000 investment, assuming it continues to perform as it has over the past decade. A $100,000 investment in VGT could grow to approximately $134,990 after just 1 year, based on its recent 1-year return of 34.99%. Over a 10-year period, assuming the average annual return holds, that same investment could balloon to around $633,500 with dividend reinvestment. Even more astounding, over a 30-year horizon, your initial $100,000 could potentially reach an extraordinary $23.74 million, assuming consistent performance and dividend reinvestment. However, it's crucial to approach these projections with a balanced perspective. While VGT's concentrated focus on technology offers the potential for substantial returns, it also exposes investors to higher volatility. The tech sector can experience significant swings in both directions, which means VGT may see more dramatic ups and downs compared to more diversified funds. Additionally, while VGT does offer a modest dividend yield of 0.65%, its primary allure lies in its potential for capital appreciation. Investing in VGT means gaining exposure to companies that are not only market leaders today, but are also positioned to drive innovation and growth in the future. This ETF offers a compelling opportunity for growth-focused investors who believe in the continued dominance and innovation of the tech sector. Now that you know what these ETFs can do, let's combine them into a powerful portfolio strategy. Remember, diversification is key to minimizing risk while maximizing returns. By blending these 3 ETFs, you can create a well-rounded portfolio that taps into income, growth, and innovation. Here's how to put it all together. Step 1. Allocate your investment. To strike the right balance, consider allocating your investment across these 3 ETFs based on your financial goals. 40% to SCHD. This allocation provides a stable foundation with reliable dividend income and moderate growth. SCHD's focus on high-quality dividend-paying companies adds a layer of safety and income consistency to your portfolio. 30% to QQQ. QQQ brings in the growth potential of leading technology and growth-oriented companies. This allocation helps you capture the high returns of the tech sector, which has consistently outpaced the broader market. 30% to VGT. VGT complements the portfolio with concentrated exposure to the information technology sector. Its focus on innovation-driven companies offers substantial long-term growth potential, especially in our rapidly evolving digital economy. Step 2. Reinvest dividends. By reinvesting dividends from all 3 ETFs, you can take full advantage of the power of compounding. This strategy ensures that your returns are maximized over time, as dividends contribute to both income and growth. Step 3. Regularly rebalance your portfolio. Market conditions change, and so do your financial needs. Regularly rebalancing your portfolio helps maintain your desired asset allocation, ensuring that no single ETF dominates your portfolio due to its outsized growth. Rebalancing also locks in gains and mitigates risk. Now let's look at the potential growth of a $100,000 investment split according to this strategy over 30 years. SCHD, 40%. Starting with $40,000, this portion could grow to approximately $2.26 million, considering a combined annual return of around 12.95%. QQQ, 30%. A $30,000 investment here could grow to around $3.2 million, driven by QQQ's strong performance and a combined annual return of 19.22%. VGT, 30%. Another $30,000 investment in VGT could balloon to about $7.12 million, assuming a combined annual return of 21.28%. Total portfolio value after 30 years. By combining these ETFs, your $100,000 investment could potentially grow to over $12.6 million, offering a balanced mix of income and growth. Additionally, you could generate substantial annual dividends, further boosting your income. Before we wrap up, I've got a question for you. Which of these 3 ETFs intrigues you the most, and why? Drop your thoughts in the comments below, and don't forget to subscribe.